Hello, everyone. Welcome to our webinar today. This is Uncovering Working Capital and EBITDA Benefits with a Robust SIOP Process from TriVista and StockIQ. We have a great team with us here today that will be talking through all things SIOP, Sales, Inventory, and Operations Planning. You've got Jeffrey Porter from the StockIQ team, as well as Jerry Joyce, Philip Lee, Zach Diabel, Michael Vahi, and Rachel Billingsley from TriVista.
Is a robust SIOP process. So we've got TriVista and StockIQ both on the call. That is because we are strategic partners. These are three recent client engagements in which we successfully partnered and were able to drive transformational value for our clients. I'm not going to read these each to you, but you can see that these are some substantial savings. And I'm going to pass it off now to Jeffrey Porter with the StockIQ team. He's going to walk through some of the capabilities.
Thank you, Zach. Certainly appreciate that introduction. Start off by just talking about this strategic partnership that TriVista and StockIQ have pulled together. At the core and the heart of each of our organizations is the focus in on supply chain. TriVista from a process, assisting in network redesign and everything that Zach mentioned. From the StockIQ side, we complement this by providing supply chain planning software that covers demand planning and replenishment. We'll go into a little bit of a detail on that. Another thing that I'd like to mention when we begin talking about this integration, we talk about software and we talk about a deployment of new processes. By the way, we're really focused in on people, process, and tools. We feel that you can get the most out of your investment in either one of these services and or tool when we begin combining all three of them together. So what I'd like to do now is just share a little bit of the offering from StockIQ. We will be referencing these as we go throughout. So the software capabilities that StockIQ brings to the table starts with demand planning, forecasting, seasonality, looking at hierarchies. Hierarchies support the S&OP process. It's really the core and the heart of where we start. The demand planning is oftentimes a starting point for the organization for establishing plans. It's the heart for what we do from a replenishment perspective. We like to see one number in the organization. The SIOP process drives that. Second component that we'll be talking about is a replenishment planning. Replenishment is about the supply that we're responding to the demand profile with. This might come in the form of purchase orders, work orders, manufacturing orders, transfers, and then optimization there of the inventory that resides within the network. Supplier planning. This is all about monitoring one of the pieces that's quite volatile at times that can cause excess or shortages. And this is around the supplier. It's managing your suppliers, developing scorecards for them, calculating the variability in both the lead time and are they delivering on time, are they delivering in full, and capacity planning as well. So when we begin thinking about that supply base, be it a contract manufacturer, being a vendor that we're purchasing from. Inventory planning. Inventory planning is all about lining up and identifying that right amount of inventory that should be stocked in each one of your individual locations for each stock. The inventory planning goes for the parameters that are helping us with replenishment. It might be calculating a safety stock level, a reorder point. It might be analyzing what our optimal inventory should be. We're identifying how much we're willing to invest in inventory to support a certain service level. Lastly, capacity planning. This is a rough cut capacity planning module that is looking at both internal and external capacity. It gives us perspective on where we are as it relates to our requirements from a build perspective from now through the entire planning horizon. That planning horizon might be the next 6 months, it might be the next year or 18 months. But when combined, all of these core elements of the SIOP process, which the TriVista team is going to walk us through, will be highlighted in there. Demand, supply, inventory, and capacity. Thank you for that. We look forward to sharing with you how StockIQ and TriVista have partnered to put in what we would consider to be leading practice from an industry perspective moving forward.
So hi everyone, I'm Rachel Billingsley. I'm going to walk high level through the SIOP process and how StockIQ and TriVista integrate into it. StockIQ is the light blue and then TriVista is the dark blue. Feel free to put any questions in the chat also as I'm going through this and we can get to those at the end. So starting with demand plan, as your forecast and sales orders come through your ERP, they can be directly downloaded into StockIQ. StockIQ is configured to meet your company's specific needs. StockIQ helps track inventory levels, safety stocks, reorder points, mins, maxes. Again, this is all configured specifically to your company, and we will work with you through that configuration process. The supply plan will account for all capacity and material constraints, production and supplier variation, and EOQs and MOQs. And an executive review meeting is very important to get alignment on sales and operations team and to align on the strategic alternatives for any constraints. Now, steps 5 and 6 are really only for manufacturing businesses. If you are solely distribution, this might not be applicable to you. The master schedule produced by StockIQ utilizes the forecast, sales orders, inventory, and custom set configurations and parameters. Once the master schedule is set, work orders and purchase orders are released.
Now, just to emphasize number 4 that Rachel mentioned, executive SIOP review meeting, this is probably one of the biggest gaps, and it's so critical. I was just recently at a client where sales and operations had not met for 15 months. And it's like, how does operations run the business if they don't get the input from sales? So the real objective here is that it is at an executive level, and at least once a month, sales and operations gets on the same page for what's going to happen in the next 1 to 3 months. And then they review that the next month so that there's no finger pointing, because everyone went into the next month or so with full agreement on what the plan was.
That's a good add, Jerry. Thank you.
I'd like to add a little bit. When we talk about a SIOP process and a robust SIOP process, oftentimes the reasons that they fail starts at the very beginning, which is acquiring the information that's required to support that SIOP process. So we begin thinking about an organization that might be selling 20 or 30 or 40,000 different SKUs. How do we actually manage and deliver the information that helps the team evaluate what the inventory, the supply, and ultimately what we're going to plan to? So in that very first step, it's very critical that as we begin a new SIOP cycle, it might be at the beginning of the month, it might be a weekly cycle, that we can very quickly deliver the information to each of the individual teams. It might come in the form of what is our demand plan and our revenue projections for the next 18 months. In this overall SIOP process, delivery of this information, both very timely and in a format that can be consumable. One of the things that I'd like to highlight in all of this process, when we begin engaging sales folks and we begin engaging finance and we begin engaging operations, oftentimes, well, I shouldn't say often, they're always dealing in different parameters. Sales teams comes in from a revenue perspective. We're looking at dollars from the finance. Operations is units based. If we're getting and we're collaborating with our clients and our customers, oftentimes those forecasts will come in for a product family and it's coming in at a revenue. So we have a lot of variability in how the information comes in, but what's most important is that we can deliver it in a consumable fashion for each of the entities. Operations speaks units. We need to begin thinking about aggregating that information in 10 to 15 at the most product families or categories so that we can begin isolating and analyzing whether we're on target or off target. So I would tell you is, as important as this process is, we oftentimes see it failing on the front end when we don't have the information that can be delivered in the right formats quickly and summarized at the right levels. Yeah. One of the other things that I'd like to bring into this overall picture as we begin thinking about a SIOP process, it's been our experience, and I think TriVista can speak to this, that there's about 10% of the companies that we engage with that actually have a formalized process. Oftentimes in an engagement, there's informal SIOP going on, meaning the sales team might be communicating with the purchasing agent. That's a form of SIOP. It's not very comprehensive, but people are communicating, right? They're coming in and they're giving their input. Really what we're talking about in this process is we're talking about uniting the entire organization so that when we get to that final step 4, we've all arrived at one consensus number that we can all agree on. May not always be enthusiastic about the number, but we're all agreeing to march forward for that next month at that perspective. So that 10% number is it's pretty shocking, right? Meaning there aren't a lot of companies that have deployed this. We think that there's a lot of opportunity in the marketplace to engage in a SIOP process. It's not, I'm going to say it's not easy, but it's also not difficult. It really takes that discipline that gets applied.
Related to the inputs of a demand plan, but I think this relates to Jeffrey's comments and what, you know, the way we look at it is it starts with a statistical sales forecast by SKU based on 2 to 3 years or whatever you have available of historical demand, and it should also accommodate reflect seasonality and trends, and it also needs to ignore one-time events that occurred in the past that would not be repeated. So you come up with a statistical forecast, but that doesn't have any, the statistical forecast has no idea what's going on in the future. So then you need to augment that with sales intelligence, which would include things like promotions, key customer wins and losses, you know, new product introductions, planned end of life, so forth, and all sales data that would not be, you know, that would not be reflected in historical sales.
And Jerry, I see another question that came through with that. So while you're on that page, once we have all the consensus, there's a question that came through on what is all entailed in the executive review meeting.
Yeah, so I probably should have said that when I was talking about it, but yeah, so for sure you want to get all the right players together in sales and operations, and usually it's best to include finance in there as well. And you're going to first of all review the last month's actual sales versus the plan. You're going to review the performance of any new products versus the initial forecast. You want to review any end of life plans or zero demand that wasn't expected. And then you want to discuss all the sales intelligence that I just mentioned, you know, any key wins and losses over the last month, any new promotions that have been decided upon, and any other one-time events that came up in that last month that operations would need to know to make modifications to the supply plan. Then you also want, for the benefit of sales, to discuss any supply constraints. Those could be purchase parts or manufactured parts due to issues in either your supply base or your manufacturing operations, and then put that all into a big mixer and agree between sales and operations on the next month plan. So that at a high level, that's at a minimum what you want to discuss in the executive review meeting.
And Jerry, just to add to that, you know, in an ideal state, in that executive review process, you come into there with some work done on the demand consensus, on the supply and capacity balancing. But ideally, you come in with a couple of scenarios that are monetized, where executive leadership can then make the correct call that says, you know, we have a constraint or we have an imbalance. We have options 1, 2, or 3. These are the financial and service ramifications related to each. And that's a really good, rigorous, robust executive review process.
Right.
Yeah, good comment there, Philip, as it relates to the activities that are occurring. So much of what's occurring before we get to that review meeting is these analyses, so that when we get to that executive review, it's typically an hour in length, right? Where, hey, we bring 2 to 3 scenarios that are our top priorities that we begin reviewing. These are the things that we need executive consensus and help on making decisions. Can we push the envelope here, right? And if we don't reach our targets, are we okay sitting on $5 million in extra inventory? These are the types of big decisions that we need consensus from the organization on.
And we recommend that at least depending on the size of the company, but we work primarily, both of us, StockIQ and TriVista, in the mid-market space, but we would recommend at least that a chief operating officer, COO, or if not the CEO, participates in the meeting, so that you have somebody that oversees both sales and operations. And like Philip said, it's really important to have finance there too, because if there's some capacity constraints or some material constraints, supply constraints that are going to impact revenue for the next month, you know, everybody's aware of that up front, and there's not a lot of emotion and finger pointing when it happens as a surprise.
One additional comment that I was thinking about on the front end, I shared a little bit of a statistic on when we begin looking at the marketplace and how many folks have adopted a formal SIOP process. I'll speak to the technology as well. We find that about 40% of the prospective clients that we're working with start with spreadsheets. So spreadsheet is oftentimes the starting point for this data. I would tell you spreadsheets is difficult, right, to get that replication. So we're a big fan of technologies from the standpoint that delivering the information and being able to summarize so that we can do these scenario plans is oftentimes quite challenging in a spreadsheet type of a format. If the process is too onerous to create the information to support the process, it oftentimes breaks down. So again, as we're talking about this, we're talking about a technology component, we're talking about a process component, and people that are committed to all of this. Another comment as well, as we begin embarking on this, there are some tier 1 applications like an SIOP installation that might take you 2 or 3 years, multiple millions of dollars. We're not talking about that scale in here. We're talking about process overviews and process development and technologies that are affordable, right? They're affordable for the marketplace. So as you begin looking at this and you're thinking about embarking on this step, the returns are substantial, but it's not a huge investment. It's probably more of a commitment on the organization's part to move forward. We're talking very affordable from the technology and from the process development as well as we're going in.
Good afternoon, everyone. My name is Mike Vaghi. I'm going to take you through the next couple slides here, and we'll start to talk a little bit more about the specific areas of your business that would be impacted by improving the SIOP process. So we've kind of laid out up until this point, the structure of what's all included in a robust SIOP process, but want to start to take you into the business impact. First and foremost, I know a lot of folks on the call are very familiar with what we're talking about here today in terms of EBITDA, but just as a quick plug for those that maybe don't deal with it on a day-to-day, EBITDA is simply an acronym standing for earnings before interest, taxes, depreciation, and amortization. It's essentially a good metric for understanding a company's operational performance and their profitability. One of the main purposes is for either investors or analysts to understand how a company is performing on their day-to-day operational activities, and it's irrespective of the company's capital structure, probably most importantly. So it normalizes it across companies as well. So really just wanted to plug that in here. But the main question is, how does a robust SIOP process impact EBITDA in a positive way? And so there's several different areas. One of the more obvious byproducts of a robust SIOP process is the reduction in working capital, right? You might understand that improving and optimizing your inventory is going to increase your turns, reduce or even eliminate some of your excess and obsolete inventory, and therefore you're left with just a reduction in working capital. That's certainly the case, but there's several different impact areas of your business that we want to speak to today that that ultimately benefit EBITDA and improve your bottom line. So very first one, labor efficiency. There's two areas in most businesses where you can gain labor efficiency as a result of an improved SIOP process. And the first one is your direct labor cost on your production line. So, if you incur or if you realize high frequency of parts shortages, you'll surely incur high production line downtime and an inefficient labor force. Also, if you are maybe you have a sub-assembly stocking strategy, let's say, in preparation for a customer build to order customer order, you may have to delay that, postpone that because of part shortages, material shortages, and then have to ramp up labor, maybe in the form of overtime, let's say, when parts do finally come in and you're trying to rush that order to fulfillment to meet your customer demand. And so, direct labor is certainly one that is impactful by improving your SIOP process. Secondly, your planner and buyer group, your procurement team, can also realize a labor efficiency gain by, and this is where actually the StockIQ portion of this enables it. Not only does a robust SIOP process enable this, but StockIQ's ability to more or less automate a lot of the review of plan and also launching of purchase orders. No longer would your planner and buyer team need to meticulously review every detail of, let's say, a purchase order going out to supplier. They may only need to review in great detail the exceptions. So let's say 10 to 15% roughly of those purchase orders going out. So there is a labor productivity to be had in the procurement group as well. We typically see it around 25 to 30% productivity improvement in that group specifically. Outside of labor, there's also a pretty direct hit for the food and beverage folks on the call, let's say, or even the chemical or pharma folks on the call. Those that deal with expiration dates or shelf life constraints. Quite obviously, if you're unable to plan that inventory accurately, you may have large inventory write-offs due to that expiration or due to those constraints. And that's a direct hit on your bottom line as well. So as you optimize your inventory and as you plan more accurately to your forecast, you can reduce those write-offs pretty significantly and gain in EBITDA as well. I'll skip over a few of these. I want to speak to a few that actually enable top line growth and drive revenue as opposed to maybe cutting costs within your organization. As you can imagine, the more that you can become a service provider, a reliable service provider to your customer, through on-time delivery or just reliable execution, this can lead obviously to repeat sales from current customer base. Also could lead to future business opportunities as well, or even just increased sales from current customers as well. And it can certainly also create better margin opportunities for future business. So there's two lenses to look through, I should say, when thinking about how a SIOP process can impact EBITDA. It's not just the way you can become more cost conscious and sort of reduce your cost to create a better margin. It's also it enables you, or can enable you, to drive the top line growth as well. One thing to note even is as you optimize your inventory and your planning, you may also realize that you have created some capacity within your operation and can therefore leverage that capacity for future sales as well, future revenue.
Yeah, Mike, I was going to add to that. That's a great point. The having confidence in future available capacity enables the sales organization to go out to market with confidence, understanding there is available capacity, and customers appreciate that, and obviously will take hold of that available capacity, assuming you're a high service provider for them.
Absolutely. Yeah, and actually one more on the service end of this is. And this I guess would be reducing potential cost, so technically speaking, but you may be a business where if you're late for a customer on an order, you may incur a fee for that. So there's also late charges to be had on delayed fulfillment. So certainly something not to be overlooked, right, when thinking through how you go and improve your SIOP process. The last one I wanted to talk to on this slide before moving to a project example is carrying cost savings. This one is going to be significant or maybe insignificant depending on your excess inventory value, but nonetheless, something not to be overlooked. There certainly is a cost incurred by every business by holding any inventory at all, right? And so your cost of that capital, storage costs related to that, insurance and shrinkage, all can add up. We see it around 10 to 15% of that inventory value as the potential savings. So if you're sitting on $5 million of excess inventory, there's $500,000 right there in just carrying costs alone that you could reduce or eliminate by implementing a more robust SIOP process.
Mike, last quick thing, if I could, not mentioned here, but also for those of you that are in the ESG concern space, having a rigorous plan that's out into the future, that's balanced that enables you to procure and deliver materials to your facilities without air freight, without expedite, without having spoilage and loss, really plays into that as well. So a really nice enabler of an ESG platform is a really rigorous and solid SIOP process as well.
Great point. Great point. Yeah, there's the more we dig into it, right, there's second order and third order positive benefits that all would not be enabled without the improvement in the SIOP process.
And Mike, really quickly before we go to the next slide, there was just a question that came through here, and I think it's a good place to address it, is just what is typical savings percentages when it comes to inventory reduction as well as EBITDA improvement?
Yeah, that's a great question. And it's across the board. We deal with a lot of different companies with a lot of different inventory profiles and things like that. But what we typically see from our past experiences, we're going to have revenue lift that's going to be in the 3 to 15% range typically. In terms of what we're going to see from an inventory reduction, it's typically in the 10 to 30% range. And then what we typically see in terms of EBITDA is going to be 5 to 20% improvement upon what is the baseline EBITDA position.
Yeah, I think that you alluded to it, Philip, but really the product profile, the SKU profile is what's going to make that up and see how vast those savings can be. It's obviously different by industry, but appreciate those ranges.
Awesome. I think the next slide here, we just kind of, show a project scenario here, a real project example from earlier this year where, StockIQ and a TriVista SIOP improvement was within the scope of work here for one of our clients. So you can see we've listed out some of the symptoms that our client was facing and some of the estimated benefits and financial impact as a result of, both of these things coming together. At the very top, we laid it out for you, and this was the common byproduct that we were anticipating, a reduction in working capital. We saw the opportunity to go from 1.2 to 3 turns, resulting in $8 to $9 million roughly in working capital reduction opportunity. But then you can see that we listed out several other areas where EBITDA improvement was an opportunity as well, over $1 million worth, which for this client, 4 to 6 percentage points. We mentioned labor, right? Labor efficiency. This client faced, as we mentioned, high part shortages, and therefore high production downtime. So direct labor on the production line as well as the procurement team, right? There was fairly inefficient and undefined procurement processes in place. So by implementing StockIQ and having a more robust planning process and SIOP process, we estimated about $150,000 annually just in labor alone to be saved. Philip mentioned the expediting of material, not only from an ESG standpoint. All right, that's another great benefit related to expediting inbound. But there's also a cost when you go and do that, both inbound and outbound, to try to fulfill orders in more of a rush. This client in particular had fairly reactive purchasing habits, right? Because they couldn't plan quite accordingly the way they would have liked to. So we saw another about $160,000 annually as an opportunity there. I mentioned carrying costs can be a pretty big hitter, depending on what that excess inventory opportunity is. So 10 to 15% on the $8 to $9 million in excess inventory. Obviously that'll burn down over time, but there's your roughly $1 million in potential savings, right, in carrying costs alone. So something we definitely want to emphasize to not be overlooked. There is certainly a cost to holding inventory, and when it's inventory that doesn't need to be there, there's definitely potential savings to be had. And then lastly here, we have one other piece here, that is the footprint reduction opportunity. Not necessarily applicable for all businesses or all companies or scenarios, but this client happened to kind of check the box on really 3 main boxes, I would say. First of all, their excess inventory value happened to be happened to take up meaningful space. So if your excess inventory doesn't necessarily take up meaningful space, then maybe this opportunity doesn't apply. Secondly, their current footprint scenario, they were on a 3-building campus. So, consolidating to maybe 2 buildings wasn't going to necessarily be a problem for them. So if that is, if you're a single building headquarters and manufacturing building, maybe this doesn't apply again, but for this client it did. And then third, they were in a geographic area where there was high likelihood of a new tenant coming in. And so what we sort of identified here was, roughly $200,000 to $250,000 in sublease income, potential sublease income to be had, again, just by, at the very start, stemming from a more robust SIOP process and optimizing your inventory. So there's several different ways when you kind of start to peel back the onion and look under the covers here of, all the benefits to be had and financial impact to be had that drops down to EBITDA as you create a more robust SIOP process in your organization.
I'd just like to jump up to the top and just make a comment. When I don't know what industries the participants in the webinar are from, but when you see 1.2 turns, like to a lot of people, you're going to probably laugh. And then we're taking it from 1.2 to 3. And this is a manufacturing company. And that's alone generates 8 to 9 million in savings. I come from Hewlett-Packard in the technology sector, and even in very complex electronics manufacturing operations, we expected 5 to 6 turns of inventory. So this is a very conservative number of the 8 to 9 million. So I just wanted to point that out, that it's we're not bragging about going from 1.2 to 3, but it's that was a starting point, with 8 to 9 million in working capital improvement.
What's typical in terms of burn down timing? So when we're saying the $8 to $9 million of reduction, how long?
It's a good question. I mean, we typically see if there's any reasonableness in trying to manage excess inventory, 6 to 18 months. However, it could take up to 5 years, but I would say that the typical is more the 6 to 18 months to burn down excess inventory, assuming that you still have. If it's completely dead, then it's eternity. But and you need to take a provision and write it off. But the sooner you can identify a slow moving part and stop buying more or making more, you're closer to hitting the 18 to 18 month burn down. And whether you're private or public company, GAAP usually allows you to take that time period without taking a hit to your EBITDA.
And Jeffrey, I was going to ask, because talking about the burn down timing made me think of the executive summary screen with the burn down. If you want to explain that really quickly.
Yeah, certainly. Yeah, thank you, Zach. So one of the things that we've done inside of the StockIQ application is it's very operationally focused, as I talked about the demand and the supply. But another real key element in monitoring is identifying these opportunities on the front end. So we've built out an executive dashboard that focuses very importantly on where it's our burn down, what can we expect coming in. So we can actually pinpoint and identify based on the demand plans and the dead inventory, whether it would be a 6-month, an 8-month, or a 15-month type of a burn down. And essentially what we're doing is looking at the demand plan for each of the individual SKUs. We're identifying them as slow movers, recurring, sporadic demand. We're also looking at the current inventory plans and balancing that off of a demand plan. Obviously, more inventory coming in doesn't help situations on the burn down, so we identify where we have open supply orders, but that's what that's focused on. Why we're also mentioning the executive dashboard, there are dashboards out here that identify where our revenues are being attributed from. We look at where the inventory opportunities exist within an organization. And one of the services that we offer is we can very quickly complete this assessment with 4 pretty simple files, looking at sales history, on-hand information. We begin looking at a few other key elements if you're a manufacturer, bill of material, and we can make an assessment on the front end very quickly to identify where these opportunities exist.
And just to add to that, Jeffrey, so what we do typically in an engagement or before an engagement, based on the business, based on all the diversity of different businesses, is we can usually in a diagnostic in 3 to 4 weeks identify what is the EBITDA opportunity that would come with SIOP, as well as what could be the working capital, alluded to what Jeffrey was just talking about, really related to inventory positions today relative to optimal inventory or future inventory and future burn down of inventory. So usually in 3 to 4 weeks, we can give a really good perspective around the opportunity for SIOP. So you're not all the way in, you can kind of test the waters and see what that value would be for your organization.
Yeah, great point, Philip. And it's not a theoretical exercise. We're actually working with information coming from your operation, the history. So it's pretty targeted and focused. Another comment in here as well. We start talking about executive level overview and expectations, and we talk about operationally how we execute. Oftentimes there's a pretty big gap between expectations and what we're able to do. What the SIOP process allows us to do is it allows us to align expectations to what can actually be accomplished, and not to understate that, right? So developing the information to help the executive level management understand what's going on in an operation, and the trade-off is sometimes one of the big challenges. We spend a lot of time analyzing data, putting it in spreadsheets, and they typically want to see what I've seen with organizations is a different scenario. So we do this analysis, and it's like, well, what if we operated on this type of a service level? Well, you go through those exercises. So the emphasis on the technology and the ability to align the goals and objectives of the organization with operationally how we're executing and the opportunities is oftentimes a difficult thing. The SIOP process brings those together so that we're working more efficiently and in alignment with where the organization needs to go.
One of the other questions that it came up earlier that we didn't necessarily address was, what are the inputs of an inventory plan or safety stock plan? And probably a lot of people on the webinar are familiar with the traditional APIX algorithm, which is the square root of lead time times the standard deviation of historical demand times the Z-score that's associated with your desired service level. And that's all well and good as a very basic safety stock algorithm, except for two things. It doesn't take into account seasonality whatsoever. It considers that variation, and it doesn't take into account trend. It considers that variation. So that traditional APIX algorithm kind of breaks down. And just to kind of give a plug for the supply chain software of StockIQ, they look at lead time, they look at historical demand variability. They also add in historical supply variability, of course, desired service level. And then it uses its own previous or historical forecast error to put all that together to come up with a statistical forecast. And then the other thing is that many SKUs, as you probably all know, have highly sporadic demand. So all of the traditional algorithms assume normally distributed variation of demand. But if you're highly sporadic, all those algorithms break down. And StockIQ has a number of algorithms for calculating safety stock for, at the user's discretion for SKUs with sporadic demand, that are much more accurate than trying to use, effective, I should say, than trying to use just standard statistical algorithms.
So the first one that I have here, I know you already touched on this briefly, but maybe just to reiterate, how long does it usually take to quantify the size of an opportunity within an organization with regard to implementing SIOP and the supporting software?
Yeah, it's going to depend on the organization size. Typically, our space we're working in is mid-market, sometimes on the smaller mid-market size. If it's a couple of plants, you're a $200 million enterprise, 3 to 4 weeks. If you're multi-facility, if you're if you're in the $500+ million range, maybe 4 to 6 weeks. But coming out of that, we're going to identify and tease out what are all the benefits that you have. We're going to assess where your service levels are today. What's your inflation? How are you passing inflation on in terms of price increases Is there gaps? How are you utilizing your facilities capacity as a function of SIOP? What are the working capital takedown opportunities that will develop in conjunction with working with StockIQ? So it's going to be a really rigorous identification of the benefits, fairly low cost. You're not all the way into an implementation, but as part of that diagnostic, we're also going to be teeing up all the things that would be necessary in the implementation. So it isn't just a finding, it's a finding with some development of what would be next steps in implementation. And then coming out of that would be the benefits, the realization of benefits in terms of time, the required investments in terms of costs if we were going to help, as well as some things that we would suggest that the organization could just do with existing personnel and capability, as well as the things that we would suggest that we would come behind and support in an implementation.
Awesome. Thank you, Philip.
And just to add, Philip started, I don't, again, know the revenue levels of some of the participants in the webinar, but, Philip kind of started with 100 to 200 million. If it's like a $50 million company, we could easily go in, and do that assessment in 1 to 2 weeks. So like he said, it's the size of the company. But if you're a $50 million company, we could do it in 1 to 2 weeks.
Yep. But Gary, you can answer this one. In your experience, what are some of the roadblocks that you've seen in implementing SIOP and StockIQ?
Well, that's a great question. So I would say the majority of mid-market companies still heavily rely on Excel. And, the people in planners and buyers, they love their spreadsheets. And so one of the most difficult things is, and this is a key part of the implementation of our SIOP processes and StockIQ, is to sort of break that mold where they're, and get them to believe in the data coming out of StockIQ, which is, when it's configured correctly, is highly accurate. And I think one of the primary roadblocks is if for some reason it's not configured to optimize to a certain company's business processes, then they lose the new users lose faith in it, and then they tend to revert back to their old processes. So, the implementation process is just really important, that the system gets configured correctly, and that there's lots of follow-up with the client on making sure that, like from our standpoint, the client, making sure that they sustain it. But it's mentalities that are the biggest roadblock.
There's one other question that, Philip, I think this one would be pretty geared towards your expertise. So where does your product model fit into a company's supply chain journey? If they've currently got decentralized ordering, high test ordering, and no MRP, is it too soon?
Depends. We would want to see what that looks like. If we're decentralized and we don't have an MRP, but we have the inputs that we could use to understand demand, the bill of material, the requirements, netting against inventory, there's something we could probably do right away to get the business up and running. Obviously, the benefits of having an integrated planning software like StockIQ sitting on top of APIs, that's not going to be available at that stage. But there still are benefits that could be realized in the near term. We would need to see how detailed the information is. We can create statistical demand plans, statistical inventory suggestions, things that a business in its early stages might be able to deploy at an initial stage to get by and have significant benefits. Ultimately, what we'd like to see is the move towards an ERP environment with APIs where we could patch in a great software like StockIQ for full and optimal benefits.
And one final question here, Rachel, if you go back to the case study slide.
Yep.
Aside from the obvious influence of TriVista and StockIQ, what do you see as common threads amongst these three projects that really made the biggest difference in success in terms of people, process, and tools?
Well, I would say that a commonality would be to have significant opportunity would be rapid growth. That was primarily sales driven, where a company expanded far beyond its processes that it had developed to sustain that level of growth is usually the biggest opportunity that comes out, is that, you know, they had something in place that could kind of navigate 50 million or 100 million or 30 million, and all of a sudden it's 2 or 3x 2 years later. And the things that you would want to have to sustain, you know, think of an organization where you've got somebody planning, you know, for a certain amount of production or procurement or what have you, and all of a sudden it's 3x of what that is, and they don't have a tool or a process in place that would enable them to scale with that level of volume increase. That's where these tools, these processes really step in and really help an organization, and that's where the greatest benefit comes. The other thing I would add is complexity of the organization. If you have bills of material that are long, that have a tremendous amount of source materials to procure from, and this situation happens, it's even further. So it's that kind of thing. When you get significant growth or you have a significant degree of complexity, those are really opportunities generally where this really comes out. From my perspective, I'll let Jerry elaborate a little bit on if he has a different perspective, but from my perspective, significant growth that happens in a complicated environment is usually where SIOP is realizing we can get back to getting scalable growth with EBITDA returns that are better than they used to be. And in the meantime, we're kind of just trying to survive.
The key success factor is when you've got an executive team and an operational team that is truly interested in learning and improving their business, you know, and willing to invest you know, in processes and systems and people to make that happen.
Yeah, that's a great point. And I know that I speak for all of us. We are very appreciative of everyone who joined today. Happy to walk through this. It's obviously something that we're all very passionate about, but it was great having you, and hopefully took some benefit out of it.